Helloworld. This is our stock of the day. It served investors with a trading downgrade after the market closed just before the long weekend. There's a red light right there. In fact, Phil was drawing this to our attention. I'd left the office by that point, but his alarm went off. The travel package company now expecting underlying earnings for FY26 to be in the $57 to $62 million range. Now that's higher than last year, but well off the $64 to $72 million range it had previously guided. It points to adverse effects from the Middle East conflict, both on consumer finances and airline operations. International flights departing from Australia on the three major Middle Eastern carriers have been cut from 150 a week before the conflict to 0 in March, then to around 82, where we're currently at. And it has reopened, and shares are down just over 2% as of recording. So, Phil, yeah, look, obviously we know what's going on in the Middle East conflict, how that's affected travel stocks, rebookings, reduced airline capacity. What are you seeing here and off the back of that update, downgrade?
Yeah, I was sitting at home watching a movie with my son Friday afternoon. My phone starts buzzing. Oh, yeah. Friday, 4:30 Friday before a long weekend trading update. Can only be good news. It wasn't good news. The downgrade versus previous guidance at the EBITDA line was about 15%, at the NPAT lines probably about 20%. So 20% downgrade, shares off 1 to 2%. What does that tell you? The market was expecting this. Other travel agent companies, Qantas, Webjet Group, have all put out trading updates. So there's no surprises. That was just their turn. What this highlights is the importance of using a travel agent. So what they explained on their call is when the world started to erupt, they had $170 million worth of cancellations, rebookings, because people wouldn't fly, couldn't fly, the airlines cancelled, weren't available. So there was a whole bunch of passengers stranded because just because you can't fly Emirates or whatever, the hotel operator in London or the tour operator in Paris couldn't care less. It's your problem, you've paid for the booking, you're not getting your money back. Right, so all of a sudden you've got a passenger who can't fly or no longer wants to fly a Middle Eastern-owned airline. They've already paid for hotels, accommodations, etc. It is your problem. So good luck trying to fix that using AI. Right? Who are you going to call if you booked it yourself? Well, it's your problem, middle of the night, finding your carrier. So people called a travel agent, in this case Helloworld, and they found them an alternative carrier at about 50% of the time. So because of the shortage of capacity, because of if you're desperate, you're not paying high. If you're not desperate, you're not giving away high commissions to get the traffic. If you're Qantas and Singapore Airlines are just picking up traffic that's no longer flying Middle Eastern airlines, you're not paying much commission to get that traffic. So Helloworld's trading up. There was more. Half of these bookings cancelled. The other half booked on cheaper carriers, less revenue to them. They took the hit. They've already seen some of that demand come back, and they flagged September quarter bookings are up low double digits. So looks to me like a push to the right. Stocks on 7-8 times PE, 7% dividend yield because they're maintaining a 5%, or they're aiming to pay a 5-cent second half dividend yield on par with the first half, so 10 cents. It looks like not a storm in a teacup, a function of what's happening globally. You lost a quarter of revenue, you'll pick it up in the September quarter. Good buying opportunity, so I think it's a buy. But it highlights the importance of a travel agent. Otherwise, who are you going to call if your flight gets cancelled and you've still got hotels and trips?
Well, yes, particularly in this age of AI where more and more, I guess, people are going online via AI to book their holidays, but that is clearly fraught. So how do you view it, I guess, obviously, given what's going on in the travel sector, and potentially how this compares with other travel stocks such as Flight Centre?
Yeah, I think that's the biggest thing. These have never been businesses with great moats. There've always been so many travel agents. If you didn't like that one, you used that one. If this one didn't give you great service, you moved to that one. So when a business has very little in the way of moats, you can't expect it to have very high return on equity or be a wealth winner for you long term. And long before COVID and long before the problems in the Middle East, Helloworld had low return on equity. It's still got low return on equity. It does make a profit other than during the COVID period, but it's not going to be a great business. As Philip points out though, it's incredibly cheap at the moment. So, if you're looking for a long-term wealth winner, it's not a company that you should be looking at. If you're looking for something that may well give you a bit of an uplift, because it's so dirt cheap at the moment, yeah, it's very cheap. It's on a PE of 6 or 7, and on a PE of 6 or 7, as Philip points out, you get a decent dividend, and you're more likely to get the PE at some stage or other going up, and you make a capital gain at the same time. So not a buy for our Teaminvest members, but if you're a trader and you're looking for short-term gains, it may well be one of those that you could look at.
I am going to call that a double buy. You're saying
As long as you don't say Teaminvest, right?
Yeah.
I'll get killed by our members.
Here and now, it is a buy.
Here and now.
Okay, all right. All right, that's our stock of the day. Hello World.